to SB Talks. Today is Wednesday, March 20th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Today, Nick and I will be discussing the latest RBA rate decision, the end of negative interest rates in Japan, and the Stanford Brown fixed income sector review. Welcome to all our listeners. Starting at home today, we had the latest RBA rate decision yesterday. No change in rates, probably as expected. But anything within the statement, anything in terms of the news coming out around it that's unexpected or changing your views in terms of where we're going with rates here in Australia?
No, I don't think there was anything in there that was particularly surprising. There was no real market reaction yesterday. I guess the main point of interest was just a slight tweak to the language. So last month they said further tightening cannot be ruled out. This month they said nothing can be ruled in or out. So really in each way, very non-committal.
So it's almost an easing of if the pendulum was slightly towards tightening, it's now a touch more neutral.
Yeah, it's definitely a more neutral tone, and some people saying slightly dovish, but I don't think we can interpret there's a rate cut coming soon. It probably means that the next move is a rate cut, but the current market pricing is that is a second half of 2024, kind of August, September, as we've mentioned before. Some banks still have November. So really, in the details of the statement and the press conference afterwards, it was, very much data dependent. There's a bit more progress on goods inflation, as we've discussed, but the RBA is still very much focused on that services inflation. They note that wages growth is strong, and that productivity has been weak. And so where wages growth is at the moment at over 4%, is not really consistent with their inflation target if productivity is negative. They also note, I guess, that real income should pick up as inflation comes down, and with those 4% wage growth, people should start to see some positive real income growth,
which could be potentially making, as you've talked about, the last mile of inflation a bit trickier.
Yeah, and then we also have those tax cuts coming in mid-year, which will be in their models as well. So they do see, I guess, a bit of an improvement for the consumer in the back half of this year. So that's why I think they're still fairly cautious about kind of,
being overly explicit in terms of their guidance. And I guess that's their job, right? They want to keep their options open, but I guess the reaction to it is very much been one of, okay, well, if rate increases, possibly still on the agenda, people are assuming that they're not. Whether that's the case or not, obviously data dependent, it could be, but probably just puts more momentum behind the rate cut coming later in the year.
Yeah, I mean, Governor Bullock spoke about energy prices, coming down for some consumers, although for some businesses they might be going up. So that's sort of, at least they're not going up consistently anymore, so that's helpful. She talked about unemployment going up, but still described the labour market as still on the tight side. So I think everything's kind of moving gradually in the way that they want it to happen, but they still have inflation getting into the top end of their target range, kind of middle of next year. So it's very much steady as she goes, keeping options open, data dependent.
Big news story out of Japan in recent hours and days is that the last holdout on the negative interest rate world is potentially gone here. We are seeing them move to a radical interest rate of 0 to 0.1%, I believe. A good news story.
Yeah, it's they're the last of the central banks to have negative interest rates, or NIRP as we call it, negative interest rate policy. So, after I think that's been in place since 2011, so quite a long period of time. It's their first rate hike since 2007. So really, quite different to a lot of the rest of the developed market world, which is sort of has gone through that rate hiking cycle and now is paused and about to cut. They're kind of going in the other direction.
Japan, obviously, a relatively unique sort of economic situation. They are probably ahead of the curve in the aging population and have that already sort of quite advanced playing out in their country. They don't have significant immigration, unlike some of the other parts of the world. So quite significant to actually be able to achieve, I guess, an inflationary situation there. What brings that about?
So, clearly they're exposed to food and energy prices and tradable inflation like a lot of other countries. So their core inflation, excluding food and energy, is running in sort of the mid 3.5%, I believe, at the moment. And this is an economy that for many years had deflation.
Yep.
So for them, 3.5 is, that's pretty strong. As you say, tight labour market, but really nothing in the way of wage growth until this year. So we just last Friday had the Shunto negotiations, which is the sort of time of the year, the spring labour market negotiations that go on each year between the big trade unions and the big employers. So Rengo, who's the big trade union that represents about 7 million workers, negotiated a 5.3% wage rise.
That's huge. That's huge. Huge in most parts of the world, but particularly for Japan.
That's massive.
Yeah.
That's that, and as I said, 3.5% kind of core inflation. So that's real wage growth.
Popping of the champagne corks at the Bank of Japan with that result.
Yeah. Now that's just for the large employers. Companies like Toyota gave their workers the largest wage rise in 25 years.
Wow.
So that'll then kind of flow through to smaller companies, which may be not able to pass on the same kind of wage rises to their workers. But still, I think that was what pushed the Bank of Japan to move yesterday, actually at the same time as the RBA. So the two announcements came out kind of within a few minutes of each other almost. Very, very interesting. They've also got rid of that yield curve control. You might remember They were targeting the 10-year yield, and they gradually kind of widened the range in which that could trade. So originally it was set at, I think, 0, and then they moved it to 50 basis points, and then a 1% ceiling. Now they've got rid of that. But they still said they would step into the market if needed, So I think, and they also said, it was quite a dovish statement as well. They said financial conditions would be accommodative for the time being. So I don't think anyone's expecting them, to put through the series of rapid rate rises that we've seen in the US and Australia.
When they finally reach the territory they want to get to, they're not going to squash it with a rapid rate hike.
That's right. Yeah. It's going to be very, very gradual. So the market only has the cash rate, which has now moved to 0. To 0.1, as you said, getting to, I think, 0.27 by the end of the year. So not too much in the way of aggressive tightening going on there.
Back into healthy territory, and we were talking this morning, and you mentioned they've been able to achieve something that's quite elusive here in Australia, actual productivity gains from their workforce.
Yeah, unlike Australia, they've had to squeeze more out of their shrinking labour force, and they actually do have productivity growth there. So 5.3% wage growth, some of that is compensation for workers actually, delivering more, and some's obviously for inflation as well. So they've been trying to get that virtuous cycle of that wage price inflation that other central banks are trying to quash.
They've been chasing it for 20 years.
Yeah.
So they're happy to at least be back into that side of the ledger.
Yeah.
We've got the Fed meeting tonight, I believe. Are you expecting anything significant there? Obviously, a lot of hype at the start of the year about the rate cuts, how aggressive they would be. That excitement has probably cooled a little bit over the last month or two.
Yeah, look, the Fed officials, and we've spoken about this on previous podcasts, have done a pretty good job over the last couple of months of really pushing back the market expectations for aggressive rate cuts. So I think in December we were looking at, market pricing in 6 rate cuts this year. We're now down to between 2 and 3, below the dot plot. So the Fed dot plots, and we'll get a new set tomorrow morning, had penciled in 3 rate cuts from the Fed this year.
Yeah.
So 75 basis points of cuts, and markets are around, I think, 65 or something like that now. So we might actually see the dot plots move from 3 cuts too.
Right.
So that is possible tomorrow. I don't think the market would be too bothered by that. It's sort of in keeping with, as I said, what Fed officials have been saying over the past few months is, we're not going to move that aggressively. And then we've also had some of those sort of upside inflation surprises through January and February that has just created a bit more caution around.
A bit of a rationalization of the thinking there. We've spoken on the podcast in recent weeks on, I guess, the momentum that we've seen in equity markets, particularly US equity markets. That momentum probably cooled somewhat as that reality set in that the Fed's likely trajectory is not going to be as aggressively down as the markets maybe were pricing in 3 months ago.
Yeah. I mean, we've seen markets kind of really, I think, and I might have mentioned this on previous podcasts, markets really turn their attention more to the growth outlook and less focus on Fed moves and inflation. So even though the bond yields have risen back up to 4.3 for the 10-year and 4.7 for the 2-year, it really hasn't bothered equity markets too much.
Because of the reasons for the driver, the market's becoming confident that the economic platform is pretty solid. The recession likelihood has been dialed down. Therefore, the focus turns from the rate hikes and the recessionary impact of that to, the growth outlook.
Yeah, absolutely. If I could just turn back to the Fed meeting,
Yeah.
One other thing I think will be interesting tomorrow is, you might recall, they have the dot plots I mentioned for 2024, 2025, but they also have what's called the longer run dot plot, which is their estimate of the neutral rate of interest. Now, that's been stuck at 2.5% for a long period of time, and people are actually saying, well, maybe, given the strength of the US economy, the neutral rate isn't 2.5, maybe it's 3.5.
Right.
So, and the market has sort of priced that in. It certainly hasn't got a 2.5 rate kind of, built into the longer end of the yield curve. So,
what's your take?
So I think it is higher. I think, given the strength of the US economy, despite all the interest rate rises, that, the neutral rate probably is around 3.5. So that is something that people will be focused on tomorrow, if there is that move in the long run neutral rate up from 2.5.
Has an impact on how you value many assets.
No, but I think it just shows the thinking of where rates might kind of come back down to over the next 2 years. If they're going to come back down to 2.5, or they're going to come back down to 3.5, so...
Has an impact on your long-term economic growth assumptions potentially as well, I guess.
Yeah.
How accommodative the long-term environment's going to be from a monetary policy perspective.
Yeah, absolutely.
We get the China monthly data dump. Anything from that? Anything out of line? We know that obviously there's been a series of challenges there, and they somewhat continue.
Yeah, the February data was all stronger than expectations. So retail sales, industrial production and fixed asset investment came in stronger. I mean, it's always a bit noisy around January, February because of the timing of the Lunar New Year. So you really almost need to combine the 2 months together and then look at the previous year's 2 months. I mean, it was a little bit better than expectations. Maybe things are improving there, but I think... there's still those long-term structural issues. So, their growth drivers are weakened. The property market is still in a slump. The manufacturing outlook, even though there's a little bit of an upswing, is still fairly weak. Unemployment rose in the data that came out the other day. Youth unemployment still a problem. So I think it doesn't change the fundamental sort of long-term picture facing China. It is interesting, actually. They're out now using, kind of trying to re-engage with Western companies to try and get more direct investment to bring them back. But I think people have been burnt there. So they've got a long, hard road ahead of them to try and convince foreigners to invest in China.
I think the onshoring momentum, for example, to North America, Central America, is a very well set path now. I don't see that reversing, and a lot of companies at the very least have wanted to diversify their supply chain. If they're still in China, they want another supply chain route to give them an alternative in case we see another COVID scenario or worse in terms of a military buildup and things of that nature.
Yeah, and there's anecdotal stories of number of expats living in China. It used to be everyone wanted to go there, because it was the great sort of opportunity, and just the number of people moving there has declined quite a lot. So I think that's indicative of just the degree of engagement between the West and China that it makes it difficult for them to attract investment.
Now, you've just wrapped up and presented to the Stanford Brown Investment Committee a very thorough review of the fixed income universe. Do you mind sharing with us, at a very high level, what you did there and how you think about, as an investor, approaching that space in portfolio construction?
Yeah, so what we've done is we've actually broken down cash and fixed income to a lot of sort of smaller sub-asset classes. So we've got cash, what are we trying to get out of cash? Well, that is not an income generating asset. That's really all about liquidity, being able to, potentially have dry powder. So if markets fall, you can quickly use the money in your cash account to maybe buy into markets, etc. It's also a way to accumulate dividends and income, etc. So cash is not for income, but it's more about liquidity and capital stability.
And flexibility in portfolios.
Yeah, so
we move up the spectrum from
so
there.
we approach cash from that perspective, not seeking the best returning cash funds in the world, but the ones that had the highest sort of capital stability and liquidity. And then kind of moving the next level up, we have an asset class that we call short duration credit. So these are funds that are sort of cash plus in what they're trying to do.
What are they invested in?
So they're investing in typically things like Australian floating rate notes. So these are issued by the largest banks in Australia, for example, that are floating rate, so they don't have any interest rate risk in them. But then they have an additional kind of credit premium because they're riskier securities. Or they're issued by mortgage-backed securities, against mortgage pools, etc. So they tend to pay a bit better than cash, but obviously have a little bit more risk, a bit more price volatility. And then we have fixed interest. So that's Australian fixed interest and global fixed interest. And that's really about, largely government bonds, a little bit of corporate bonds.
So that's the bond market, which is dominated by a number of, state player issuers of debt.
Yeah, well, US Treasury is the biggest one, followed by, European governments and Japan and big government borrowers. So that's really a high grade market where we're really looking for managers that can try and find which countries, which sectors, which parts of the yield curve to invest in and add value there. And the purpose of those asset classes is really the negative correlation to equities. The protection in portfolios when equity markets sell off, people tend to flock to government bonds. And then we move into sort of the higher risk fixed income categories, what we call investment grade credit. So these are companies that are borrowing in the bond market that are good quality companies. They'll pay better yields than governments. And then we get into the junk bonds or high yield borrowers who pay, currently around 9-10% potentially.
So you use the term junk bonds, high yield. Some of the listeners might get a bit nervous hearing about that. How do you think about how and when to use those types of assets?
So those assets can be good, for example, as equity replacements. So they're risky, but they're less risky than equities.
Yep.
So and the trick there is to have huge diversification. So some of the funds that we look at have 500-600 bonds in their portfolio. So if any one bond or company goes bust, it has almost a negligible impact on the overall portfolio. Yep. So that's the trick.
Diversification is absolutely key there.
Yeah.
Excellent. It's a very comprehensive wrap up of the sector, and it's a very broad sector. So I'd encourage all our listeners to talk to you with your advisor and to understand more, and you'll see that begin to filter through into your portfolios over the weeks and months ahead as well. But for now, I want to thank you, Nick. Very comprehensive as always, and I want to thank all our listeners. Speak again soon. Take care.
Thank you.